Chevron Corporation is an interesting dividend stock to consider. On the one hand, the business is booming, profits are soaring, and cash flow is increasing. On the other hand, longer term, worldwide governments are working to move away from fossil fuels, and that could endanger the company's cash flows in the longer term. So, in this situation, I've modeled the valuation of this company, incorporating the fact that in the longer term, the company will lose market share in that industry. So, I want to share with you what I think is a fair price to pay for Chevron stock, given that the longer term does not look very exciting for these types of businesses.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so my cash flow valuation model for Chevron Corporation has three distinct sections. I'm gonna specifically point out the section when I get to it where I've evaluated how Chevron Corporation will adapt in the long run, how the business will adjust to the changing circumstances that governments are trying to move away from fossil fuels. They're trying to encourage people to purchase electric vehicles and how that will impact the company's valuation. I'll spend some time detailing that, where I have that incorporated in this model. But first, let's start with the free cash flow forecasts. And so in 2024, Chevron Corporation likely generated $15 billion in free cash flow, and that's expected to increase to $25.6 billion by 2029. And this is according to Wall Street analysts that are following Chevron stock. They still believe the company is going to increase its free cash flow by roughly $10 billion over the next 5 or so years. So the near term looks very strong for Chevron Corporation. From 2029 to 2034, I'm forecasting that the company's growth rate in free cash flow slows down and increases from 25.6 billion to 33.7 billion in 2034. Starting in 2035, I'm forecasting another slowdown in the company's free cash flow. And here's where I'll discuss how it's going to be impacted by the decrease in fossil fuel consumption and the increase in the electric vehicle transition. I'm forecasting that Chevron's free cash flow will grow at a 3% rate from 2035 to infinity, even though I'm forecasting worldwide developed economies will grow at a 5% rate nominally. So when I'm forecasting Chevron will only grow 3%, but the worldwide economy will grow at 5%, I'm forecasting that Chevron will lose market share in the overall economy. Chevron's revenue and oil revenue overall will start to lose market share considerably starting in 2035. I think that's when we'll have better technology with electric vehicles. And if you've been watching my videos, you know I'm not a fan of electric vehicles right now. But I think by 2035, the industry will have developed enough, the ecosystem, the technology will be developed enough where it will make more sense for more individuals worldwide. Right now, it only makes sense for 10% or fewer of the population. But as the technology improves, it'll make sense for more people by 2035. I think it'll be about a decade for this technology to improve to a point where roughly half of the population is using electric vehicles. Now, it may or may not be there. It may be a lot less, it may be a lot lower, depending on government policies. Are governments going to continue pushing electric vehicles on people worldwide? So that's my forecast, and that's how I'm incorporating that risk to Chevron's business is by the long run growth rate being only 3%. So in 2034, I can calculate the terminal value for Chevron, and that takes into account all the free cash flow the company expects to generate between 2035 and infinity. And that value sums to $488 billion. So now that we have all of those free cash flows expected in the future, we need to bring them back to today and find out what they are worth at this point in time today. and that number is $352 billion for Chevron. I discounted Chevron's cash flows, and now we can go to the section in blue here. I discounted Chevron's free cash flow at a weighted average cost of capital of 10%. I've given them a cost of debt of 7.5%, a cost of equity of 11%. I calculated the cost of equity using the capital asset pricing model. Given that the company's beta is 1.08 according to Yahoo Finance, a risk-free rate of 4.5%, a market risk premium of 6%. The company's market cap is around $261 billion at the time of this calculation, and the total debt was $25.8 billion. So I've given them a target capital structure of 25% debt and 75% equity. And incorporating that all together is how I arrived at the weighted average cost of capital of 10.11%. This is the denominator I use to discount these free cash flows back to today. And if you don't already know, the formula to discount free cash flows is you take the free cash flow as the numerator divided by 1 plus the weighted average cost of capital in parentheses to the power of however many number of years you're discounting those cash flows back. So for instance, from 2026, I've used 2 as the number of years because that's the cash flow expected by the end of 2026. We're still in the beginning of 2025, so I'm doing that as 2 years back. And then 2027 will be 3 years, etc., to discount these free cash flows back. And if you can view this formula line up here, you can see the formula for the discounting of these free cash flows. So now we can go to the red section where we arrive at the price per share. We start with the value of operations at $352 billion, add the company's cash balance and subtract the debt. We arrive at the value of equity of $331 billion. But we want to know the price per share, so we divide by the number of shares outstanding, and we get an intrinsic value per share of $183. The current market price is $157. So given that I like to apply a margin of safety, a $16 difference for a market price of $157, I could say it's slightly undervalued or closer to fairly valued, just because the margin of safety. If you're not including a margin of safety, you can say that it's undervalued. With the margin of safety, it's closer to slightly or fairly undervalued. And remember, I've incorporated that risk of the industry declining as a percentage of overall economic activity. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.